We're talking about the capital gains inclusion rate hike. Let's get into what this means for you and your investments. Hey, I'm Caitlin from the TaxForce. Let's take a look. Starting June 25th, the capital gains inclusion rate will increase from 50% to 2/3. That's just around the corner, and there's no option to defer this change. If you were hoping to lock in the current rate without selling your assets, think again. You must actually sell or gift those assets to benefit from the current 50% rate.
Yes.
But there's a silver lining for some. Graduated rate estates and qualified disability trusts will have access to a $250,000 threshold where the inclusion rate remains at 50%. This is great news for those managing these specific trusts, giving them a bit of a break amidst these changes. Unfortunately, for most of us, there's no special treatment. No exemptions for long-held assets or averaging capital gains over multiple years. And you can't share your $250,000 threshold with a corporation you own. The government is firm on this, emphasizing a fair and predictable tax environment. So, are there any strategic moves you could do before June 25th? One good one might be considering transferring properties to a spouse or a corporation to trigger gains at the current rate. This might be a strategic move if you're planning to sell a business or another significant asset soon. The CRA has clarified that selling assets before June 25th to crystallize gains won't be seen as tax avoidance. However, if your primary goal is to secure a tax benefit beyond the current inclusion rate, the general anti-avoidance rule could still apply. With the new capital gains exemption, there are also some positive updates. The lifetime capital gains exemption will increase to $1.25 million, up from just over $1 million. Plus, a new Canadian entrepreneurs incentive will reduce the tax rate on gains from qualifying small business shares. Don't forget to like, share, and subscribe for more financial tips. And remember to use the TaxForce.